Good afternoon, everyone, and welcome to today's presentation on estate planning in a declining market. Before we begin, there are a few housekeeping announcements I'd like to make. You'll receive your MCLE certificate shortly after the program. Your certificate will also be stored in BHBA Plus, our members-only community. Please take a moment to complete the survey that is included with your certificate. This program will be available in a few days in BHBA On Demand, BHBA's newest member benefit presented by Lawyers Mutual Insurance Company. And now I'd like to introduce one of our sponsors, Nancy Sanborn and Brian Joy of the Sanborn team.
Thank you, Dina. In this time of thanks, we just wanted to take a moment to thank the Beverly Hills Bar Association and all of its members for their continued support over the last year.
Those of you who may recall, prior to COVID, at Thanksgiving time, we always did a drawing where people were able to pick the charity that we would make a donation to. This year, we've picked our own charity that we will be donating to in honor of this section, and the Sanborn team will be making a contribution to the LA Food Bank in honor of the Beverly Hills Bar Association. So have a great meeting, wishing all of you a great Thanksgiving and a Happy New Year. And we look forward to seeing everyone come January.
Have a great meeting.
Have a good meeting.
Thanks, Nancy and Brian. Next, I'd like to introduce Orit Gadish of Geffen Real Estate.
Thank you, Dina. Hi, everyone. I'm Orit Gadish, broker and owner of Geffen Real Estate, specializing in representing trustees, executors, and administrators. We work with people like you, attorneys, professional fiduciaries, and with the beneficiaries and heirs of the estates and trusts, offering creative solutions to getting properties vacant and avoiding evictions when appropriate. And then we get the property ready for market with no upfront costs to the trust and estate when needed. That includes trash out, yard cleanup, minor repairs, or renovations, whatever is needed to act in the best interest of my clients and get them the highest possible price on the sale of their commercial or residential property. Thank you to those of you who have shown your support over the years, and I look forward to working with those of you with whom I have not yet had the pleasure. Please reach out to me if you'd like to connect on a Zoom call or grab some coffee to get to know each other. My contact info is in the chat box, and enjoy your program. Back to you, Dina.
Thanks, Orit. In addition to the Sanborn team and Geffen Real Estate, the Trust and Estates section is also sponsored by Glen Oaks Escrow. Marcine Klein is a full-service escrow officer specializing in probate, trust sales, conservatorship, and both court and independent administration of estate act transactions. On a daily basis, Marcine works to ensure that even the most challenging escrows close smoothly and that our clients are beyond happy with their experience at Glen Oaks Escrow. In addition, California Title Company provides comprehensive and timely title insurance protection for home buyers, including first-time home buyers, sellers, veterans, and military personnel, seniors, real estate agents and brokers, mortgage lenders, and commercial real estate professionals. Finally, Manufacturers Bank. Simplify your banking. Let Manufacturers Bank do it for you. Manufacturers Bank has a dedicated trust and estate banking team with the experience to handle all of your banking needs. Contact Brian Flores, Vice President and Senior Relationship Manager for more information. Now onto the program. I'd like to introduce Jennifer, who will be doing our legal updates today.
Good afternoon. We're going to start with King versus Pacific Gas and Electric Company, case number A163843, First Appellate District, Division 3. It was filed August 22nd, 2022. Decedent was an Alabama resident, died in a helicopter crash in 2020 in California. Decedent was survived by his surviving spouse, Wasden, former spouse King, and a minor child that was shared with King. An Alabama probate court appointed former spouse King as personal representative of decedent's estate. King, as personal representative, filed a California wrongful death action against Pacific Gas and Electric Company and PJ Helicopters. Decedent's spouse Wasden filed a motion to intervene as a matter of right. Wasden supported her motion for mandatory intervention pursuant to CCP section 387 subdivision D1B, which addresses 4 elements. 1, timeliness. 2, her interest related to the subject action. 3, the impairment of her interest if intervention was denied. And 4, the inadequacy of King's representation of her interest. The court denied Wasden's motion, finding that Wasden cites no statutory or case authority to support an heir being able to intervene in a wrongful death action brought by a personal representative. The appellate court reversed and remanded. They found that the trial court erred in finding no legal authority. Wasden, as an heir, is entitled to intervene as a matter of right, so long as she met the 4 elements in the statute. Further, the right does not violate the one action rule in Adams versus Superior Court because the defendants are still defending one action and subject to one judgment. The appellate court also found the trial court erred in finding that the Alabama probate court must determine whether King will adequately represent Wasden. Because a wrongful death action seeks recovery, that is no part of the estate of the deceased, and the proceeding is not within the probate jurisdiction. Therefore, the case is reversed and remanded before the trial court to reconsider the motion to intervene in the wrongful death action and analyze whether Wasden's interest will be adequately represented by King. The second case we have today is the Parker versus Schwartz, case number A165163, First Appellate District, Division 3. It was filed October 19th, 2022. In February 2022, after the termination of Cynthia Parker's temporary conservatorship of her estate, Parker filed a petition for return of property for declaratory relief. Her petition for return of property sought an order pursuant to Probate Code Section 850, compelling her former conservator, Schwartz, to transfer to her all of the communications between Schwartz and any person related to her service as temporary conservator of her estate. Basically all the fiduciary records of administration. On May 3rd, the probate court denied the petition as a matter of law, stating that Section 850 does not authorize a petition under these circumstances because 1, Parker was no longer a conservatee, and 2, there's no personal property belonging to Parker. Parker appealed. The appellate court affirmed, concluding that though Parker was a claimant within the meaning of Probate Code Section 850 and had standing, she did not seek any property of a similar character to interests customarily litigated under a Probate Code 850. Based on legislative history, the purpose of the statute is to provide a mechanism for probate courts to resolve ownership disputes with respect to personal property constituting assets of an estate. Cases applying 850 exclusively deal with real and personal property, whereas here documents and communications from a temporary conservatorship estate administration do not hold title, do not have value to fund the conservatorship estate or pay down debts, and these records were not previously owned by claimant. Therefore, the temporary conservatorship estate administration documents are not property recoverable under Section 850. And pass this on to Beth Acevedo. Thank you.
Thanks, Jennifer. I have the privilege of introducing our fantastic panel of speakers today. First, I'd like to introduce Elizabeth Glasgow. Elizabeth is a partner at McDermott, Will & Emery, where she focuses her practice on multi-generational wealth preservation and tax minimization, including the creation and implementation of dynasty trusts, business succession plans, asset protection strategies, charitable giving structures for business owners, real estate investors, entrepreneurs, families managing inherited wealth. She provides comprehensive advice on a wide range of issues facing mobile high net worth individuals and geographically dispersed families, including coordinated income tax planning across multiple generations. She's also an experienced counselor to nonprofit communities and works with a variety of tax-exempt entities in fulfilling their charitable missions by ensuring proper formation and management of their organizations. Next, we have Bridget Devoy, who's counsel at McDermott, Will & Emery. Bridget focuses her practice in the areas of estate planning, trusts, charitable foundations, tax planning, and estate administration. Bridget enjoys working with individuals and families to help create sophisticated, tax-efficient estate plans that also achieve a client's non-tax goals, such as family harmony, personal growth of beneficiaries, and leaving a lasting philanthropic impact. She's particularly skilled in advising philanthropists and charitable organizations on charitable giving, including negotiating and drafting complex gift and grant agreements. Bridget also helps her tax-exempt clients create, her clients create tax-exempt entities and advises on tax-exempt governance, grant-making, and related tax compliance. And last, we have Laura Stone, who is a CPA and partner with Citrin Cooperman. Laura brings over 20 years of experience to Citrin Cooperman's Woodland Hills office, specializing in real estate, trust and estate, and international tax reporting. Laura services both tax and audit clients, advising them with her strategic and transactional knowledge. Laura works with a wide range of clients, from small startups to large enterprises and high net worth individuals. She helps clients develop strategies to mitigate tax, as well as educating them about tax laws and accounting guidelines. Additionally, Laura is passionate about helping her clients transfer their wealth to their loved ones in the most tax efficient way. Without further ado, I'm going to turn it over to our panel.
Thank you. So the first test is I'm going to share my screen and hope that Beth gives me a thumbs up that she's seeing me. Fantastic. Well, Bridget and Laura and I are really pleased to have you join us today, because to be honest, this was a presentation we were hoping was going to get canceled. And I say that because when we were first contemplating putting a program together, this was quite a bit of time out, and we were envisioning by November, will planning in a declining market still be a topic any of us want to be talking about? For my 401k, I certainly was hoping it wasn't going to be true. And so we thought, well, why don't we propose this topic? And then because situations will have improved, we won't have to actually do this presentation. We'll come up with something else at the last minute. Unfortunately, here we are still in this environment that has gripped us for the last several months. And so we thought, well, we'll stick with the presentation, unfortunately, as originally planned, and spend some time today talking about really how we can be assisting our clients with a focus on both prospective strategies that they can be utilizing for declining in this environment. We wanted to make sure that we spent some time talking about the circumstance of sort of unhappy clients, unhappy, of course, not with us, but with the circumstances that these market conditions have caused them to find themselves, and, give some framework for how to field the questions that I think many of us have gotten in recent months from clients to say, well, I did this really great planning in 2021, but now my gift or my transfer has decreased in value so much. What should I do? And, investigate whether or not there are ways to, rewind or unwind transactions that have already taken place. And then conclude our discussion today with a discussion around, really on a go forward basis, what will we be thinking about as we create new trusts and strategies in the future to be as frankly reactive as possible, so that if clients find themselves in this kind of market conditions again, what could we do to best position them to react to this circumstance down the road? So we wanted to make sure we covered all of those circumstances, and really to kind of kick off the discussion about being in such a bad circumstance, we wanted to do a quick preview of how things have been over the last decade. And I'll say that so much of this conversation today has been, for me, a need to reevaluate how I approach things with clients, because frankly, for most of my career, things have been very good. I have, learned how to do estate planning in a positive environment. And what that has really meant for me and for my clients is that it is a circumstance where assets are going up in value. So there's certainly a pressure to act sooner than later so that you can capture appreciation outside of the taxable estate, get those transfers concluded. And then in the last couple of years, as we've had tax law changes that would both grant us very high exemptions and then try to take them back with sunset provisions, we've had even more pressure to sort of have a use it or lose it mindset. And this has, not surprisingly, caused many of us to work with clients where the sort of main focus that they have is making large gifts that use exemption, and that being sort of the base for a lot of the planning that we end up talking about with clients. Well, that's a circumstance when times are good, and I think Laura can sort of kick us off with really bringing the mood down in this Zoom room. So Laura, why don't you tell us a little bit about what we all know, but go through the numbers.
Thanks, Elizabeth. Yes, I will have to say that also during my career, things have been good. We really haven't had to speak about, what to do in a declining market. So, here's a brief summary of things. I think we're all aware that things are not, as good as they have been over the last decade. The markets are down across all asset classes. The World IMF Economic Outlook, published about a month ago, expects a slowdown, in the next term. So growth was, 6% globally in 2021, 3.2% in 2022, and it's expected to be 2.7% or lower in 2023. I have clients, some of them predicted that this was going to happen and they're doing well. I've got clients that shorted Bitcoin. I have a client that actually made $45 million in crypto last year and hasn't lost any of it through a program that he created. Very smart guy. But for most of our clients, it's probably not the case. And, they have assets that were gifted in 2021 that are worth less now than they were, at the time they were given. And in a few moments, Elizabeth and Bridget will discuss practical ways to unwind prior gifts and how we can prepare for future declines. But for now, with asset values, when asset values, declining, things are really on sale. For the last few years, though, we've been discussing with our clients the sunset provisions and proposed and then mute tax, reforms that we were all rushing to, help our clients. We thought things were changing in the laws, and those always seem to come out during tax season, of course, my favorite time of year. And, all of these things propelled our clients into gifting and getting the appreciation out of their estate. The question that's, arisen more recently is whether there are new opportunities now and what can they be doing in this declining economy. The answer may be trivial, but in our opinion, we should still be gifting. And this comes from the perspective that everything is on sale. And, we all like a good sale, or at least I do. A lot of the structures that we've been using over the last decade, which have been proven as beneficial, continue to have great relevance in this environment. And because it's an opportunity for us to see the rebound be captured for our clients, it's still a really good time to gift. When we think of just a straight gift using tax, normal tax exemption, with the decline in asset values, we can in essence gift more for less and use less overall tax exemption. This is really an opportunity to strategically help our clients choose the best assets to gift. The silver lining in this economy is that while our clients may have lost some appreciation in their assets over the last year, if they choose to gift them now, they will be able to gift more of the asset, hopefully capture all the appreciation out of the estate when the rebound occurs. And that's, a win. They may have assets that they were, on the fence about, and they, weren't sure if they wanted to gift. They're waiting it out. And now with those depressed values, it's actually an opportune time. So another interesting thing that's happening in the market is that there's lack of liquidity, lack of access to liquidity, and M&A activity has actually slowed down. There's a lot of delays in private company sales for various reasons. I have a lot of colleagues in this space. We have a full M&A practice, and they've got deals happening right now, but they can see deals for like the next 2 quarters. But then, the pipeline of new deals coming in or new opportunities has really slowed tremendously. Where that becomes relevant for our clients is that, that's what appraisers look at in order to assess and determine the lack of marketability discounts for our closely held assets and, more importantly, privately held business interests. So for a client who may have been interested in giving a gift of a private company interest this past year, but for some reason held off, they can expect to see a larger lack of marketability discount today based on the current conditions in the declining market. This is a good time to revisit those assets and assess the opportunity. Again, it's on sale, everything. They could give more for less. Bridget, what are some of your other strategies that you're using?
Yeah, well, in talking about estate planning, right, we're talking about value that donors can transfer to trust, but we also want to look at value that we can potentially transfer from a trust to another trust. So for some of our clients, they may have 3, 4, 5, 10, maybe 15 trusts that they've created over a period of time, maybe a series of very successful grants and then some installment sales to other trusts. And there's different types of grantor trusts, right? And some are more advantageous than others. So this is a great opportunity to do a really thorough review of your client's trust universe, right? And the different types of flavors and what's out there. So for instance, they may have generation skipping exempt, GST exempt trusts, and they may have non-GST exempt trusts. So this could be a good time if there's, say, perhaps some very depressed assets in the non-GST exempt trust. A GST exempt trust could purchase those assets at a very discounted value compared to what they may have been even a few years ago. And the hope is that when the economy gets better, knock on wood, that's going to skyrocket in value, and you're all of a sudden going to have a lot more value in a more valuable trust, a GST exempt trust. You also want to look at the perpetuities provisions in a variety of trusts. So some trusts may be shorter terms. You may also have created some dynasty trusts over time. So we'd want to try to find assets in shorter term trusts that we could shift over to perpetual trusts. Additionally, there may just be some terms in some trusts that, from a individual grantor's perspective, they like those terms better. But when we are doing this, you really want to take special consideration in looking at who the beneficiaries of these various trusts are. In an ideal world, you'd have a couple and they've created a variety of trusts, but they're all for the same beneficiaries, right? It's all for their descendants. What you don't want to do is put the trustee, particularly perhaps if the trustee is yourself, but you don't want to put the trustee in the awkward position of favoring certain beneficiaries over others with these sales. Particularly, you want to pay attention if there's been more than one marriage and you have trusts for different sets of children, you know, first spouse's children versus second spouse's children. That could really put you in a sticky situation, so to speak. So we want to be careful when evaluating that. And then if we get the next slide. Okay, so let's talk a little bit about our lovely friend, the GRAT, right? GRATs have been extremely popular over the last period of time. It was frankly hard to lose at a GRAT, just like it was hard to lose at the stock market. We had very low interest rates, great returns in the stock market. And so that 75-20 rate that was applicable was very low. So we said we had a very low hurdle rate. Now it's a little bit higher. If you listen to some people, it could get a lot higher. And so, you know, you begin to question, is a GRAT really the right vehicle? However, GRATs are great in a declining market as well. The main reason being that if a GRAT fails, it just comes back to the donor again. So you basically have a redo, so to speak. So you give up the opportunity, you know, the time cost opportunity there, potentially transferring value. But as long as you've done essentially a zeroed out GRAT, you're parting with little to no gift tax exemption. So that can be very appealing for some clients, maybe that are, you know, concerned about the volatility in the market, or you know, getting assets back sooner rather than later. You might want to consider a shorter term GRAT. You may also wish to consider a GRAT that ultimately pays out to a SLAT, spousal lifetime access trust, giving the donor the opportunity, if they need it, to dip back into those funds as long as they remain married. But the key feature, which is great about a GRAT, is that in a market in which assets might decrease, they come back to you if the GRAT ultimately fails. Now, Elizabeth, do you want to talk a little bit about comparing the GRAT to some other options?
Yes, and this is a time where I really feel my practice is a little bit on its head. And I apologize if you can also hear the fire engine outside agreeing with that statement. And the reason I say that is because for a long time, I have been a big advocate in comparing for a client, you know, whether or not to consider doing a GRAT or whether or not to consider doing a sale to an intentionally defective grantor trust, because I'm very interested in dynastic planning for clients and wanting to take advantage of generation skipping transfer tax opportunities, I was generally falling into the category of let's look to a sale rather than a grat. So just as a quick reminder for grats, they do have one negative, even though they have this nice benefit in the declining market that they don't fail. If they are successful, and we do have assets moving out to the beneficiaries that the client selected, if that beneficiary is, someone of their generation or a child, that's great. That's sort of the ideal type of beneficiary for a grat. However, if the recipient at the end of the grat term is either a grandchild or trust that may ultimately benefit grandchildren or even more remote generations below, then it becomes more difficult, because unlike the grat structure that allowed us to essentially claim almost zero use of gift tax exemption when the grat was created, for GST tax purposes, the rules wait until the conclusion of the grat, sort of see how it worked out and say, if you would like at the end for this to be exempt from generation skipping transfer tax, you do have to apply your exemption based on the success of the grat. In contrast, in the sale to the intentionally defective grantor trust model, instead what clients are typically doing, as I think have been talked about in many cases in these presentations, is the idea of putting some degree of assets into a grantor trust. A rule of thumb that a lot of us have used is about 10% of the value of a subsequent sale transaction, and then selling an asset into the trust. The benefit of that in comparison to the grat is, well, yes, it does require presumably quite a bit more gift tax exemption. It also allows you to go ahead and apply that GST tax exemption right up front with the gift at the same time at the value that's presumably pretty reduced at that moment. And again, all the appreciation that may successfully occur from the transaction with the sale, much in the same way as the grat, is being captured for your beneficiaries, but now being captured GST tax free. So for a long time, I've said, yeah, grats, that's fine. If they fail, you just have to pay my attorney's fees. And nobody really thought that was a no-fail option, because they said you're very expensive. So that still feels like a little bit of harm to us, but that's okay. But I was really advocating for sales. But then in this declining market, I've had to reevaluate how I've approached that conversation, because now I'm presented with clients who are really concerned that if they sell their assets and they go down in value, we may end up doing reverse estate planning. And what we mean by reverse estate planning is that in our simple example where an asset was sold into a trust that had maybe about 10% of the value gifted in originally to sort of support the integrity of the sale, if that asset goes down in value, now we've got a problem, because that trust still owes the assets back to the grantor. Presumably in the example where they go down all the way potentially to zero, the assets that were gifted into the trust will actually have to be now paid back to the donor in satisfaction of that sale in some way. So we lost all that exemption that we used because it came back. And that, that's certainly some poor planning that we'd like to try to avoid. It could be even worse, though, if you consider doing this type of transaction with a trust that has been well funded, has been successful in the past with its transactions, and not just has this little 10% gift that got started, but maybe has some really meaningful assets. Again, if those sale assets go down to zero, potentially a big portion, maybe even equal to the gift that you were, or the sale you were originally trying to make, all of those assets may end up coming out of the trust back to satisfy the sale terms, even though the asset that the trust is now holding on to that it purchased is worth zero. So grats now, I'm spending a lot more time talking about them. I'm becoming a fan. And it's just, again, having to me reframe how I think about so much of the traditional estate planning that I've looked at. But there is one that's tricky that I really didn't think much about, and I'm glad Laura's here to tell us from the accountant's point of view, the importance of paying attention to basis.
Yeah, I mean, something that we've never really had to deal with also is, the fine print of carryover basis, right? We're keeping with everything's on sale and looking at the receipt and looking at the fine print. We all know the general rule that when we make a gift, the donee receives the donor's carryover basis, right? But the fine print states that if the donee sells the property at a loss, then the donee must use the lower of the donor's basis or the fair market value at the date of gift. So if I purchase stock for $100 and today it's worth 80, meaning it has a built-in loss of 20, if I gift that stock to my daughter and she turns around and sells it for 80, let's just say on the same day, the loss has disappeared. She doesn't get to take a loss. Nobody gets to take that capital loss because her basis is the lower of the fair market value at the date of the gift or my basis. So, another interesting thing to note is if it was sold somewhere in between that $100 and the $80, nothing happens. There's no gain or loss. It's a quirk in the tax rules. So, if we're not careful in the assets that we choose, we could be, or choose to gift, we could be, in effect, losing out on benefits for our clients. And this has become, even more of a discussion most recently when we're having our clients harvest losses and doing some tax planning for them, things like that. Another good strategy that I'm seeing is, Roth conversions. I know it's an old strategy or, things like that, but, while the markets are depressed, they can convert their IRAs into Roths, and then all of the, appreciation will then continue to be tax-free. And they're also lowering their entire estate by paying the tax on that Roth conversion. And then, their beneficiaries in the future won't have to pay tax when they have distributions. The other thing is then the actual owner right now of the IRA doesn't have to take distributions. There's no RMDs on Roths. So that's another thing, that we're using. Next slide, please. So, now, what do we do if we've gifted something and it's gone down in value, right? And we have, I'm going to call it gifter's remorse. A lot of our clients are saying, well, can we just rescind the gift or just say it didn't happen? I mean, it didn't happen, right? I mean, they'll just give it back to me and it didn't happen. There is guidance in the tax code to rescind sales transactions within the same year. However, it's not, it doesn't extend into the gift tax world. So, something to consider is that, we need to go back and review trust documents. Hopefully nobody's drafted bad trust documents here, but there are some poorly drafted trust documents that I've seen. And, a gift is only complete when a donor has relinquished sufficient dominion and control over the asset. Sometimes it's helpful to take a closer look at the documents to make sure that the document doesn't give the donor a constellation of power that allows him or her to choose beneficiaries. Then it wasn't a true gift. There's also a technical footfall. The IRS guidance says that stock transfers only occur after the books and records of the corporation have been updated. So if we have a client that gifted stock, but never got around to updating the books and records of the corporation, I mean, we could go back and say that the gift never happened. That's not always perfect. It doesn't extend to partnerships and reporting of deeds, but it's something, that we can look at. Just a word of advice though, well, before I get into that, it's also possible that if a gift was made to a trust and the donor never informed the trustee and the trustee never accepted the gift didn't occur. So, in my career, those are normally things so far that we've kind of, turned a blind eye to, or as soon as we found out, we went back and made sure things were documented correctly and that everything was in place to prove that it was a proper gift. But, in this kind of a market, those may be big fines and to say, oh, well, maybe a gift really didn't occur. The word of caution, though, is that we want to be consistent. We don't want to say, well, if we have a client that that isn't great at record keeping and doesn't, follow through with all the steps that you guys as lawyers give them to make sure it's a complete gift. If they have a habit of doing that, and it's kind of going to happen in the future too, then we can't really pick one year and say, oh, well, this technically just this year, it wasn't really a gift, right? We want to be consistent and make sure we're looking at the entire picture before we, pick out those things and try to unwind the gift. So, I actually have a client who came to me this year, and they were gifted. Well, her mom put her name on the deed about 30 years ago. The mom continued to live in the house, rented the house, collected all the rents, and I think they only found out on the, after she died, that she had recorded the deed so long ago with, the child's name on it, or the beneficiary's name on it. And so, she was asking me, well, what's my basis in the property? And I said, well, it was an incomplete gift. Your mom retained all control of the house, and you never got any of the rental income. She paid all the expenses. I mean, she just put your name on the deed for convenience. So, we should be looking at those things as well. Bridget, do you want to talk about reformation?
Yeah. So another thing when we're talking about how can we get a do-over is, can a trust agreement be reformed, right? Essentially changed. And it's sometimes harder to do than not. Probably the best candidate for that is where there's a clear Scrivener's error. That's where case law is most comfortably on our side. There's been some other interesting cases batting about over time. Some of you may be familiar with the Getty v. Getty case from 1986. And that's an interesting one, particularly in these times, where J. Paul Getty had several sons, and he decided for one of his sons that he was going to get very little income. He was going to get, I think, about $3,000 a year from of income, while some of his other brothers were getting to share excess income equally. And at the time, it probably seemed okay to Mr. Getty, because this son was also set to inherit very sizable fortune from his maternal grandfather, who was an extremely successful German industrialist. But this was in the late 30s. The case was in the 80s, but the actual trust was created in the 30s. Unfortunately, what happened later was the very successful German industrialist business was confiscated by Hitler. So the parties later came to court and tried to explain that this wasn't the intent, and that J. Paul Getty would not have made the trust this way if he had known. But the court, I think, rightly found that this was a mistaken assumption of fact. And even though at the time J. Paul Getty assumed his son would get wonderful amounts of money later on from his maternal grandfather, that wasn't enough for the court to reform the instrument. They basically said, if you make the wrong assumption about what's going to happen in the future, that's not our problem, right? So similarly, if our clients create a trust today and they think, well, if this other thing's going to be so successful that we're going to design the estate plan this way, well, if the assets decline later, that's too bad. So an alternative in the planning that they could have done here was said that his son Ronald gets each shares equaling the fortune, but that his share is potentially reduced by the amount he gets from another trust or from his grandfather. There's different ways we could have done that. There's also been instances where people have tried to argue that a gift was incomplete. One that's kind of an oddball case was a Pennsylvania case from 1980, in which a gentleman, Mr. Berger, wrongly understood the law and thought that he had to gift his assets to an irrevocable trust in order to comply with public service conflicts of interest. And so, somewhat to my surprise, the court agreed that because it was a mistake of his understanding of the applicable law, he had that it was okay to change it from an irrevocable trust to a revocable trust. And they also found that in that case, he wouldn't owe gift tax because he presented a clear, precise, and convincing evidence that he mistakenly understood the law. And the key is at the time that the trusts were created. So I don't think reformation is by any means a slam dunk unless it's a clear kind of Scrivener's error, but something to consider.
So now that you've sort of described all these ways, unfortunately, that, you know, after having proposed this great idea back in 2021 when times were good and now clients are getting disappointed, we do want to spend the remainder of our time talking about, you know, how should we be approaching planning now, either in terms of, you know, modification to existing trusts so that they can be more reactive to changing conditions, or also just how we would, you know, structure trusts going forward so they can be reactive and so clients don't have to come back to us to ask about, you know, reformation and all these other things.
Yeah.
So Bridget, why don't you kick us off with administrative powers?
Sure. Yeah. So looking at, you know, how can we avoid these problems in the future, right? There's some administrative trust terms that we can include, and you likely are currently including in your trust instruments. One is the power of substitution. So in a declining market, you might consider swapping out a declining asset out of an irrevocable trust back onto the donor's balance sheet, and instead swapping into that irrevocable trust something that's a little bit more stable so it doesn't lose value, right? So if we all had our crystal balls or consulted our psychics or just really good investment people, we might have, say, swapped like meta stock or something like that out of the irrevocable trust and replaced it with some type of fixed asset, maybe as treasuries or even a note potentially. Then we can also include a robust sale and lending powers. This can help the trustee allocate and reallocate assets amongst different balance sheets. You can have the one include in there the trustee to have a power to renegotiate existing loan terms. That one's kind of interesting given that interest rates in this situation seem to be going further up, right? But you may be in a position where a note's expiring in a certain amount of time and you think the rates are only going to go up higher, in which case you may want to refinance now. And at least, although not in recent years at a great interest rate, it might be a good interest rate if you think in a couple of years it may be double digits. Hopefully not. And then you want to also empower the donor to be able to borrow trust property without adequate security. In this case, again, the donor could give a note for the property in the trust, locking in that value for at least whatever the current values of the asset you're pulling out. And then you can also look at who are the beneficiaries you're putting in the trust instruments. So for clients that are kind of nervous, particularly what we just discussed above, taking declining assets into their balance sheet, right? You might be concerned, well, maybe I'm not going to end up with any money and my kids are going to be, you know, living it up with their irrevocable trust. So you could consider including your spouse as a beneficiary in a trust, essentially creating a slat. And then if it need be, you could access those assets again through the spouse, provided you still remain married. And you may want to also consider, you know, whether you have a prenup in mind or a postnuptial agreement in case your spouse is no longer married, to determine how you're going to deal with that trust after the fact. You know, I probably, if you're ideal estate planning, you're not dipping back into these assets again, right? Once they're gifted irrevocably, but assuming you don't think you're going to need it, but you just kind of have the nerves, then that can be a good solution. Elizabeth, do you want to talk about potentially adding other beneficiaries like a protector?
Sure. So obviously the idea of the spousal lifetime access trust would be great for our married clients, but they're not all married. And so for clients who might have that same sense of hesitation, there is a technique that, again, a lot of us might have been historically using in our trust just to trigger grantor trust status, maybe not with really any expectation that it would be used. And this was the power to give a non-fiduciary the ability to add some beneficiaries into the trust. And a lot of time these beneficiaries were perhaps other descendants of the trust creator, family members, charitable organizations. But in fact, in a number of states, both the states that we traditionally think of as having authorization for self-settled trusts, as well as additional states that have authorized this by statute, not in California, but in other places, one of the beneficiaries that can be added back in is the donor to the trust themselves. And what's interesting about including this kind of power into a trust is that the mere existence of it, just the fact that this non-fiduciary could add the donor, does not undermine from the wealth planning perspective the integrity of the completed gift and that it is outside of the donor's estate. If, however, the declining market conditions did get to a point where, as Bridget was describing, the person, the client in this case, really needed to get these assets back and resulted in perhaps their actual addition as a beneficiary to the trust, to the extent that the reason that is happening is because their own financial circumstances have become so precarious, the expectation that they would both be added to the trust and then deplete trust assets. Yes, terrible estate planning, but frankly, at that point, tax planning is really likely not their primary concern because they've had to take such extensive action to preserve their own financial security. But that is one that, again, is me sort of reframing something that I was consistently doing for traditional grantor trust status and thinking about now sort of taking it to the next level for clients who might have, again, that real fear factor that this declining market could happen again, or it could change their standard of living for assets that they're keeping, and how can they perhaps get more comfortable in entering into these new transactions. Obviously, you're seeing a real theme, though, in the in the topics discussed on this slide, which is almost all of these things are grantor trust triggering powers. And that is definitely a big takeaway of the moment, is that the trusts that are going to give us sort of the maximum flexibility to react to market conditions, the maximum flexibility to do, reallocations between advantageous trusts and less advantageous trusts, whether that's tax characteristics, length of term, things of that nature. It's really dependent on all of the trusts that are reacting with each other being grantor trusts. So that's not to say that there is not a place for non-grantor trusts in this market, but I would say really what I'm spending most of my time talking with clients right now about are grantor trusts that can have all of these bells and whistles, or trusts that perhaps, although they may be grantor trusts based on one or two of these powers, really speaking with clients about, being proactive and potentially modifying a trust, whether it's modification by consent, perhaps a trust protector who has the ability to modify administrative powers, because it's extremely disappointing to have a client and perhaps have a solution to a problem they're having. I mean, let's say it's something as simple as they want to renegotiate a promissory note that the donor and one of their grantor trusts has from a previous transaction, to then look inside the trust and say, well, there was a solution, but it's just a solution that's not available to you specifically because the trustee powers were perhaps not written expansively enough to allow clear authority for the trustee to engage in this kind of renegotiation. That to me is of course, an incredibly frustrating circumstance for a client to be in. And so what I'm doing now, especially with clients who have some older trusts, even if we're not necessarily planning at this particular moment in time to renegotiate notes or do sale transactions between different trusts, just going through and making sure that we've checked the boxes, we have all the powers that we want to have, so that should there be an opportunity to act quickly, that we're able to do it. And I would say, in fact, thinking about the swap power that Bridget mentioned, that is one that clients in this volatile market have even asked me, sort of at the front end when they're creating a trust. Historically, I would create a trust and I'd say, someday in the far distant future, if you decide that you want to swap assets, you'll call me up and we'll do some paperwork, and it'll kind of be a bit of a project to get to a point where we can swap. And some of them now, and I will say, particularly among some of my tech-based clients, we have almost as part of the package of having a grantor trust, have already prepared sort of template swap powers so that there could be almost, a moment's notice to say, I'm taking something's taking a dive. We need to act very quickly, and just to have those on standby. But of course, that's not just having the power of substitution documents on standby, but making sure your trust itself has that power of substitution built in. So for some of these older documents, going back, kind of giving them a once over to make sure we've got the flexible tools that we need has been a really important part of my practice over the last couple of months. So thinking now about some techniques that, thinking about timing and, being able to react very quickly to certain circumstances, there's also situations where we want to be very slow. And so we'll spend a couple of minutes talking about transactions that clients are interested in learning more about, because it gives them the runway to see how a particular transfer that they're thinking about making is going to play out. And the first one of these sort of wait and see structures is called a lifetime Q-tip trust. So obviously we're all familiar with Q-tip trusts from sort of the post-death scenario, a trust in which your spouse has, a mandatory income interest, an ability to make the assets productive. And what's important though is that if you set up such a trust in your spouse during lifetime on behalf of your spouse, you also have the ability to make an election for that Q-tip to be treated as a trust for which an unlimited marital deduction applies, assuming your spouse is a US citizen. Instead of the traditional version that we're familiar with post-death, that you have 9 months and then your extension to make that assessment, here you have until the due date of the gift tax return, as well as getting an extension there. So when you contemplate the idea of families who might be looking to make a gift in January of a particular year and having all the way till October, if they extend their gift tax return to the following year, to wait and see what happens. And so what are they waiting to see what happens? So it's really just the same market performance that we've been talking about. So if it goes terribly down in value, the gift that was made, and the family realizes, wow, we don't think it can recover, you would go ahead and make that Q-tip election. And at that point, let the spouse either receive a distribution from the trust and bring it back into the married couple's hands, perhaps for future gifting at a later time. Or perhaps it's gone up in value. It, surprised the couple. And in that case, if you forego making the Q-tip election, then it is a trust like any other gift trust. You would have used exemption in making the gift. And the only real difference, though, is it's a little bit leaky. And what we mean by leaky is that mandatory income interest that is coming out of the trust is obviously coming generationally back to the donor and their spouse. And so there's a little bit of loss there. But because it's the spouse who has the ability to decide by the terms of the trust whether or not an asset should or should not be productive, there are some techniques based on how assets are structured within the trust that can sort of mitigate the leakiness of this lifetime Q-tip. The other structure that is sort of a wait and see model are disclaimers. As we know, nobody can force you to take a gift. There's definitely the opportunity to say no. And as we know, sort of from the traditional disclaimer rules, you have a 9-month window in which to make that assessment, assuming that you have not used and enjoyed the assets in that intervening time. So one of the techniques that is of interest to some clients right now is to say, well, what if I set up a trust? And we've given you a very detailed structure here of these two boxes. But you'll see these two trusts, and box B, or trust B, is the trust that the client really wants. It has all of their beneficiaries. It's the terms that if times were good, we would have probably just gifted to this trust and not thought anything about it. Trust A, though, is going to be a very streamlined trust. It's going to be a trust for perhaps just one person, and not really with any bells and whistles. It will say independent trustee can distribute to this beneficiary at any time. And now we're going to start our 9-month window to assess what's going to happen to these assets. If a disclaimer occurs in that 9-month window, and the disclaimer is happening actually to the recipient trust, there in Trust A, the result of that disclaimer will be a transfer on of the assets in some sort of non-offensive way, given that it's been going down in value, perhaps to a GRAT. But if things have gone well, the disclaimer will not occur, and by just default of the terms of Trust A, at the conclusion of the 9-month window, the assets will transfer over to Trust B, to the trust that the client wanted all along. This is another sort of wait and see technique. It's a little bit shorter than the lifetime Q-tip opportunity because it only gives us that 9-month window, but it is one that's been of interest to people who need to feel a little bit more comfort in their timeline of seeing what their assets will perform like. So we have one, I think, with 2 minutes left, sort of tricky timing issue associated with generation skipping transfer tax.
Right. So in considering this is one example where it might actually be good to be late. Normally we're very headstrong with being timely with involving the IRS, but occasionally you benefit by being late. So in a declining market, which we're currently in, you may actually be able to use less GST exemption if you do a late allocation. And that's because the statute provides that the applicable fraction and inclusion ratio are going to be determined when you actually file the late allocation, and then it's prospective. So that means if the value of the gift, when you file a timely gift tax return and you value it as of the date of transfer, if it was 100 and then you wait longer and it's actually down to 50 at the time of your late allocation, then that's all the GST you're going to have to use up. So it can be potentially very valuable. In order to do that, though, you'd have to make 2 filings. So you're going to have a timely filed gift tax return that elects out of GST exemption allocation, assuming it would be automatic allocation. And then you'd make a second return that makes the late allocation. But you do want to take into account that given its perspective only, you want to consider whether it makes sense to timely elect out if there's going to be any generation skipping transfers that occur between the original transfer date and when you make the late allocation. And then there are some kind of finer points to it. Laura, I don't know if you want to touch on any of those briefly.
Right. Just really briefly, just hopefully we'll have a minute or two for questions, but the late allocation must actually be late. So the earliest it can be filed is the day after the extended due date. So, also you can file superseded returns. If you file, all of our gift tax returns, to be honest with you, they go on extension to give us time to assess this, not particularly, but, for timing purposes, but this helps. If you file a on time 709 before the extended due date, you can file a superseded return by the due date and change your allocation. So I think with that, one last thing is to just take into account if there are any disaster extensions and things like that, then you have to, the late allocation is going to be after that disaster extension. So with that, let's open it up and hopefully there's some questions if anybody has. And if there's none.
Yeah, thank you all for this really great presentation. A lot of creative and helpful ideas on how we can help our clients in this market. There was one question that's come out so far, and so I'll put it to you. When you were talking about sales of assets from short-term grantor trusts to long-term grantor trusts, one of the questions was whether you had any thoughts on any fiduciary duty issues that might arise in connection with the sales.
Sure. So I think that's really the distinction. It depends sort of how short is short, right? So there are distinctions sometimes between clients who perhaps earlier in their term or, in their giving history, maybe just set up California trusts subject to the rule against perpetuities, but still getting, 90 or 100 years. And then perhaps their later trusts are really in perpetual jurisdictions. And then that's quite different than trusts where perhaps the sort of disadvantageous term is something like, this trust terminates when my child is, 40 years old and it all goes outright to them or something along those lines. It's definitely a fiduciary consideration, particularly if there's going to be a beneficiary in the current lifetime who may be the one to object, who otherwise would have been getting the assets outright, the sort of better performing assets if they had stayed inside the trust. But assuming that based on market conditions, the trust terms or the sale terms meet the same kind of criteria that we would look at for a trust sale between a grantor and their grantor trust. So, adequate interest rate, perhaps a security interest, things like that. We think it would be fairly hard for a fiduciary complaint that it was not a fair sale or sort of within the boundaries of the fiduciary activities.
Thank you so much. That's actually all of our questions for now. So thank you again. We really appreciate the insights that you provided today. And thank you everybody for attending. We'll see you in